Optimist of China's reopening as it extended its sideways motion near the $80 range as recession fears kept capped crude oil's potential. US inventories recorded buildups for a third straight week, yet not of the same magnitude, and next week energy traders await for any clues from the OPEC Plus Minister Convention. In this report, we aim to shed light on the catalyst driving WTI's price, assess the future outlook, and conclude with a technical analysis. Despite gloomy forecasts for decreased growth levels across the globe and predictions for recessions, market participants remain unjustifiably optimistic for WTI's future. More specifically, calls for increased demand from China after the abandonment of the strict zero-COVID policy have put a floor under crude oil prices since the start of 2023. Fueling the positive sentiment further were the statements from the Chinese authorities commenting that the number of COVID-related deaths and infections have fell drastically since the start of the year and provided more conviction for faster economic recovery from the second largest consumer of crude. Keeping crude prices capped were the rumors that surfaced yesterday, pointing out that the United States government has determined that some Chinese companies were helping Russia's war efforts against Ukraine by providing non-lethal military assistance and economic support. Should that be the case, and in light of actual evidence, investigations prove that there is militaristic and economic aid sent to Russia from Chinese corporations, we may see tensions arise between the US and China, which could have material impact on relations. On February 1st, as the Federal Reserve will announce an interest rate decision, OPEC Plus ministers are set to convene to discuss ongoing developments, and energy traders hope that the meeting may provide an update of the current production output levels of the oil cartel. According to Reuters, the panel will certainly discuss the economic outlook of the Chinese economy, taking into consideration the reopening efforts. China's pivotal shift near the end of 2022 to abandon its draconian COVID-related restrictions and opt for a full-fledged reopening have boosted optimism for higher oil demand from the second-largest oil-consuming country. No adjustment to the organization's policy are expected according to experts, as the convention is not official OPEC Plus meeting, but nevertheless crude traders will be paying attention for any clues that would aid their outlook assessments. On Tuesday, the weekly API crude oil inventories figure pointed to buildup of 3.4 million barrels in stocks, higher than the expectation for only 1.6 million, while yesterday EIA's weekly oil inventories recorded a mere 0.5 million barrels of crude, below expectation nearly 1 million of the same period. The results suggest weakening demand for crude, which may have little impact on WTI prices. Lastly, we would note that last Friday the Baker Hughes oil rig count showed that the number of active oil rigs in the US has dropped by a count of 10, reaching a total of 613, indicating a slowdown in demand. Thank you for watching.